Welcome to Policy on Demand. I'm Sindhu Blume. The House recently passed a sweeping tax bill that could significantly reshape the landscape for financial services firms and investors. Today, we're going to unpack what's in it, what's not, and what it could mean for your business. Joining me to talk about this is Brian Rebhun, PwC's financial services tax leader. Brian, welcome.
Thanks, Sindhu. It's great to be here.
So, Brian, let's start off with an umbrella question, which is what are a couple of headline issues from the bill for financial services firms?
Well, first, many financial services firms operate in the pass-through form. Since 2017, when the SALT cap was put into place, many states have enacted workarounds, or otherwise known as the pass-through entity tax. This bill would basically undo some of those workarounds by basically tying the ability to take that SALT deduction at the entity level to Section 199A, specified services trader businesses. So if you are a specified services trader business, which most asset managers, wealth managers, and other financial institutions are operating in flow-through form, you will no longer be able to take the pass-through entity tax deduction, which effectively means you're getting a effective state tax increase. And the House passing a $40,000 SALT increase to the cap doesn't really help because it's also tied to the specified services trader business definition. So effectively, for people who live in high tax states that are both partners or investors in financial services firms, they're going to get an effective tax rate increase as a result of the loss of the pass-through entity tax deduction. The other area is the expansion of 461L, which is basically the inability to take trader business losses against investment income. Historically, it was really a one-year deferral. Now it's just a carryover, which will only be allowed to be offset against other trader business income. Finally, I would say the third big issue is around sports investing. Sports investing has been a major asset class in the private equity sector. And a lot of those assets are in flow-through form, which meant that the goodwill that is associated with those sports investing would actually get a step up in basis and get an amortization deduction over 15 years. This bill would effectively cap that to 50% of that deduction, which means that the effective tax rate is going to go up for investing in sports assets.
And were there any provisions that could provide tax relief for planning opportunities?
Absolutely. The biggest one is the increase in the Section 199A deduction and really going from a 20% deduction to a 23% deduction for qualified business income. This is really going to impact real estate investment trusts and other real estate assets, which was really the benefactor of this from the 2017 Tax Cuts and Jobs Act. The other thing that got put in there is that they're going to expand the Section 199A deduction to include BDCs, which are regulated investment companies that effectively loan money or originate loans in the private credit sector. So we think that there's going to be a major benefactor of the 199A deduction, which basically for BDCs, which would effectively make BDCs similar to REITs in the fact of a 23% deduction off of what would ordinarily be ordinary income or have an effective tax rate of around 28.5%. But some of the other benefits here, bonus depreciation restored through 2029, which means that capital investments or other tech development will be fully expensed. The full deduction of domestic R&D expenses. We're seeing a lot of asset managers, insurance companies, banks spend a lot of money within their R&D expenses. The ability to actually deduct those expenses real time versus amortizing them or capitalizing them. And finally, which I think helps the private equity industry tremendously, is the return of the 163J limitation from EBIT to EBITDA. So more interest will be deductible, positive for credit funds lending, and also even more positive for private equity funds who have levered some of their portfolio companies, as more of that interest will be deductible.
And now I'd like to turn to Section 899 and how that would affect global investors.
Well, Sindhu, the new Section 899 certainly will have a big impact in the private credit space, because it's going to be a retaliatory tax on targeting specific countries, specifically around some of the 892 investors or government pension funds that are huge investors in US based private credit funds, private equity funds, infrastructure funds, and so forth. So it effectively could mean the loss of Section 892 benefits affecting these foreign governments, which will no longer be able to claim exemption from US tax on US interest and dividends. We think this will have huge impacts for treaty-based funds that are very popular within the private credit sector and would increase US tax exposure for those investors. So we're getting a lot of questions right now of, with these bring your own treaty structures or even treaty-based structures in Ireland and Luxembourg, is what's the impact for these investors today? Because this will take effect immediately and mean more withholding. Now, I think this is the one section as the Senate looks at expanding or enhancing the bill that they can provide a lot of clarity to. We are struggling to understand how this will impact broadly the global financial services market. But we think that there needs to be really strong clarification of some of the provisions, like, does it override the portfolio interest exemption? How does it really impact all the loss of Section 892 benefits? So I think time will tell as we hear from the Senate, but ultimately this could have the biggest impact to the financial services sector.
Brian, are there any indirect effects that financial services entities should be thinking about?
Well, I think the first thing is the excise tax increase on university endowments. Currently, university endowments are one of the largest investors in private equity and overall alternative asset managers in the US. A raise from 1.4% to 21% on the endowment could potentially mean that there is less money to invest for those endowments. That to me means fundraising could be impacted significantly. But on the side of the universities, we think that they're going to suffer significant liquidity issues. So for secondary funds who are looking at an ability to get potentially discounted investments in current private equity and private credit funds, this could be a big buying opportunity for them. But ultimately, from what we're hearing from our clients, they are really concerned around the fundraising environment, especially for smaller or emerging managers who are reliant on university endowments for their investment base.
And finally, Brian, while things are still uncertain, what are some considerations for companies for planning purposes?
So it's a really interesting question, and obviously we don't have a crystal ball as to what the Senate will do or change here. But I would say is if you take the kind of the three categories we talked about, right? The first one is what are the issues that could impact the financial services companies? So the loss of the PTET, right? To me, I think companies need to think about where their geography strategy really looks like. I think you're going to see many principals and investors think about where they want to live, knowing that their effective tax rate is going to be permanently increased. So relocation to lower tax jurisdictions from higher tax jurisdictions. With that comes, what are the costs to doing so, right? What are the incentives that some of the other states may offer as a result of moving jobs into those lower tax jurisdictions? With respect to some of the benefits of the bill, so like increase of R&D expenditures, the increase to 163J of EBITDA, what does that look like for your portfolio companies? What does that look like for your corporate structure? I think modeling can really help to understand is what is it going to mean for 25 and into 26 and further. With respect to 899, what does your structures look like? For firms that are in the private credit space, are you going to move away from bring your own treaty structures into more of a season and sell or in a levered blocker structure, which may have different implications, but may not have the same bad impact that 899 may have on some of these 892 investors? So ultimately is between now and then, while uncertainty exists, there are ways to plan around it and think about the structures that ultimately will be impacted both at the management company or the corporate levels, as well as funds and some of the investment levels.
Brian, I really appreciate you taking the time to walk through all of this. I know there's a lot more to come. Thanks.
Thanks, Sindhu. Great to be here.
And a note for our viewers. be sure to read the insight linked in the description of this episode about the potential impact of this bill in the financial services space. Thank you for spending this time with us, and take care.